Professor, I wanted to start with your multidisciplinary thinking and your lateral approach to things, because that's a common theme that that your students recall having learned the most from your teachings. So, can we talk about that, and can we start there, please?
Absolutely. I'm a multidisciplinary nut, and I have been for, I think, more than 20 odd years now. I've been teaching the subject for more than 2 decades. I got interested in it when I came across the famous talks by Charlie Munger on elementary worldly wisdom. Many of the people in the audience would be familiar with those talks. And they just grabbed me, and I said that this is something that I can learn from and I can teach and I can apply in my own field of investing. And I have been doing this for now 21 years, and I just absolutely love it. I can give you some examples.
Oh, I love that.
Um, so, there are all these disciplines that you can draw from. And as Munger once said, he said many times actually that worldly wisdom is very academic. And we are taught all these wonderful things in school and college, but we forget how to apply them in the real world. And I remember we were taught stuff like elementary mathematics, probability, statistics, biology, and our teachers taught those subjects to us and those concepts to us, but we never applied them. And it's only after many decades that I realized that these things have very strong practical utility. So I started thinking about those things and started applying them and started teaching them over the years, and I found that these are like really good ideas and we can apply them. And that's the way I've always been thinking about in the last 21 years. So I'll give you some examples. If you remember, in school we were taught things like in statistics we are taught a concept called mean reversion.
Yeah.
You throw a coin, you toss a coin 10 times, and it's not uncommon to end up with 8 heads and 2 tails. But if you keep doing it, you're going to end up with 50% heads and 50% tails. So over a period of time, the number of heads to the total number of tosses will approach 50%. The 50% is the mean. It's a reversion to the mean. The 0.5 is the attractor. And that's all that we were taught, and that's about it. But it has got such deep implications in the world of business, in the world of investing. If you think about it, in the world of business, we have a business which is doing very well right now, but has no entry barriers. And it's only a matter of time when competition will come in. So the returns are going to be mean reverting. It's inevitable. So you have a combination of statistics and you have a combination of elementary economics. You have business cycles. You have a period of shortage where industry is doing very well right now, but then when you combine that with psychology, when people are making a lot of money in an industry, then they can't see other people get rich and they want to become rich themselves. They want to expand recklessly, and everybody is doing it. And then all shortages are followed by gluts eventually. So there are a whole lot of things in psychology which combine, along with the idea of mean reversion, that you're going to end up with returns going down over time, because when you have a glut, the price of the commodity is going to come down over time. But not all things are mean reverting. In financial markets, for example, stock prices are not mean reverting. Stock price of a great company will keep going up. But stock returns are mean reverting.
Yeah.
So you may have a bull market which is followed by a bear market, followed by a bull market, followed by a bear market.
Like what we are experiencing right now after the pandemic and seeing a massive.
We'll keep experiencing those cycles. We'll have good years and we'll have bad years, but at the end of the day, the underlying business's performance will be reflected in markets. Markets are a mirror, so to speak, and they would over time reflect what the underlying businesses are doing. Sometimes the businesses will outperform the market, sometimes the businesses will underperform the market.
Yeah.
But in the long run, the market will reflect what the businesses are doing. So, if the businesses are delivering a returns on capital of 15%, you can't have a period when the markets are giving you a return of 30% per annum. You will have period when the market will give you 30% per annum. Then you'll also have period when you will have minus 20, 25% per annum. And that's inevitable. That's a feature and not a bug. You're going to have those periods. So if the underlying returns on capital are going to be 12 or 13 or 14%, you can't expect the markets to give you 18% per annum. So that's the nature of mean reversion that we have to, sort of incorporate in our thinking. So that's the basic point I'm making here. This whole idea of mean reversion is taught in school, how it sort of should be incorporated in our thinking in the world of business, in the world of investing. Now, if you think about the mean reversion is just one idea. The opposite of that idea is something in physics, which is also taught in school, momentum. You're taught in momentum, how a ball that is put on a top of a hill and it's put down, it gathers momentum. And Buffett talks about the concept of a snowball. And we've seen that a great business, if it gathers momentum, can become better and better over time. So we have this concept of fundamental momentum. Businesses which you call as compounders, businesses that are going to get bigger and better over time. And the interesting thing in business analysis is that you have both these different methods, both these different ideas. You have mean reversion and you have momentum. But the frameworks are different. And people, if they go wrong in using the frameworks meant for fundamental momentum and they apply them to mean reversion or vice versa, they're going to go wrong. So it's important to understand what kind of business you are looking at. Is it a cyclical business? Is it a compounding business? And then apply the right kind of framework.